the following couple weeks after the election, there was something to the growth industrials, cyclical types of stocks where they did really run. But since that time, and we're now going a few months here, if you look at those types of stocks, they've really underperformed the S&P 500 overall. And in fact, in many cases, those industry sectors are negative. Think financials, think maybe industrials, think some transports. And so I think what's happened is after that initial euphoria of all the great things that were going to happen to build infrastructure and rebuild the economy and bring jobs back, the political reality is set in that it's going to be difficult to pass legislation. We don't know to what degree we're going to get tax policy or regulatory reform, how pro-business it's going to be, et cetera. We're hearing all the right things, but we don't know anything yet policy-wise, and we're seeing that even with Republicans controlling both houses and the presidency, it's difficult. So 2015, when you X out dividends, the S&P 500 was negative, and if you X out FANG stocks, it was even worse. And I think what you've seen lately is less breadth in the market, more money going back to that sort of, more focused names, FANG plus friends, as you mentioned, which is a good description. You take that stuff away in terms of performance, and there's a reason people are investing. They're high-growing companies for the most part. But when you take those away, the stock market really has not done as much as I think a lot of people perceive at this point in time in the year. International is somewhat dependent on the health of the United States. And so I think there's an expectation that's been created there as well. There is some evidence that global economies are improving, not out of the woods, but not necessarily negative or break even. And that is a positive for global growth. Certainly any tailwinds provided by US economic growth would be beneficial to the emerging markets, and that would be a positive. So I think a cautious yes on that one, but I think it's too early to tell. If you look at Q1 GDP, it was not a great number. Everybody expects the rest of the year to be better, and everybody expects sort of additional tailwinds to be provided by better economic policy, thereby better growth, although that's going to take a while to get past and then filter through the economy. So we may not even see the effects of any policy changes until 2018, in which case it does throw the economic growth model a little bit in question. If the Fed perceives that we don't have growth, policy prescriptions are uncertain, or the economy slows, then there's nothing that says they have to raise 2 more times or even more than that. I could make a case for 0 to 3 depending on what comes next. I wasn't expecting the increase we had in March until June, but I think the markets reacted so strongly to Fed comments in February that they gave it to them and they were just going to put it in their pocket and move on. And I think that was probably smart. The next question, though, is when is the next increase? Is it June, September, December? Maybe not at all. Is there 1 or 2? And I think that's very much an open question now, depending on the economic data and policy and tax policy, regulatory policy, and economic growth that may come the rest of the year.